Gold feels like the safe choice. When inflation stays high, debt keeps rising, and markets look unstable. Buying gold in 2026 seems logical. Many people believe they are protecting their wealth by moving money into something real. That belief is exactly where the problem begins. The real financial issue is not whether gold has value. The issue is whether gold actually does what most people expect it to do over the next 10 to 20 years. For a large share of investors, especially in the US, the answer is uncomfortable. Gold often fails at the job it is bought for. Most people buy gold for three reasons. First, they expect it to protect purchasing power. Second, they believe it reduces risk. Third, they assume it will perform well when everything else goes wrong. On the surface, this sounds reasonable, but when you look at how wealth actually grows over time, these assumptions start to break down. Gold does not produce income. There are no dividends, no interest, no cash flow. The only way gold generates a return is if someone else is willing to pay more for it later. That means your outcome depends entirely on price appreciation. This is not a judgment, it is a mechanical fact, and mechanics matter more than narratives. Consider the numbers. Over very long periods, gold's nominal return has averaged roughly 4 to 5% per year. But once you adjust for inflation, storage costs, insurance, and transaction spreads, the real return is often close to zero over multi-year periods. There have been decades where gold preserved value and long stretches where it did not. Timing matters more than most people admit. Now, compare that to productive assets. A broad equity investment in the US market has historically delivered around 6 to 7% real returns over long periods. The difference between 0 to 1% real and 6% real is not abstract. It compounds into very real outcomes. For example, $50,000 invested for 20 years at a real 6% return grows to about $160,000. The same $50,000 growing at 1% real barely reaches $61,000. That gap is not caused by risk-taking or speculation. It is caused by productivity versus non-productivity. This is where many investors make a critical mistake. They confuse volatility with risk. Gold feels stable because it does not fluctuate like stocks in the short term, but stability without growth can quietly destroy purchasing power. The risk is not a sudden crash. The risk is standing still while costs rise around you. Another issue is behavior. Gold is often bought during periods of fear, not planning. People buy it after inflation spikes or geopolitical risks dominate headlines. That usually means buying after prices have already moved. The common advice to hold gold as a hedge rarely explains how much for how long or at what opportunity cost. The core problem is not that gold is useless. The problem is that many people treat gold as a solution rather than as a limited tool. They believe they are being conservative, when in reality, they may be locking themselves into long-term underperformance. At this stage, no alternative needs to be accepted yet. What matters is recognizing the mismatch between expectations and reality. If gold does not reliably generate income, does not compound, and often fails to outpace inflation over realistic timeframes, then it cannot be the foundation of long-term wealth in 2026. Understanding that gap is the first step toward making better decisions. To understand why gold continues to disappoint many investors, especially in the US, it is necessary to look beyond the asset itself and examine how people earn, save, and invest money. The problem is structural. It comes from income patterns, behavioral habits, and the absence of a clear system. For most households, investment capital is not generated by businesses or assets, but by labor. Money is earned monthly, expenses are paid, and whatever remains is labeled as savings. This leftover capital is then treated defensively. The priority is not growth, but avoiding mistakes. In this mindset, gold appears attractive because it requires no ongoing decisions. You buy it, store it, and wait. That passivity is often mistaken for safety. Behavior plays a central role. Many investors are uncomfortable evaluating businesses balance sheets, or cash flow statements. Gold removes that discomfort. There are no earnings reports to follow and no management decisions to assess. The asset feels neutral and simple. However, simplicity does not equal effectiveness. What feels easy psychologically can be inefficient financially. A common real life example illustrates this clearly. Consider a household with $100,000 in savings by their mid 40s. Concerned about inflation and market volatility, they allocate $40,000 to gold, keep $40,000 in cash, and invest only $20,000 in productive assets. 10 years later, inflation has reduced the real value of their cash. Gold has largely tracked inflation with limited real gains, and the small equity allocation has grown, but not enough to offset the drag from the rest of the portfolio. The outcome is not a crisis, but stagnation. The mistake was not lack of income, it was the structure of decisions. Another scenario is even more common. An investor buys gold after a major inflation scare or geopolitical shock. Prices are already elevated, but fear dominates logic. The standard advice they follow is vague. Gold is a hedge. What is missing is context. A hedge against what exactly? Short-term volatility, currency risk, systemic collapse? Without a defined role, gold becomes a reaction, not a strategy. This is why generic advice fails. Statements like hold 5 to 10% gold sound prudent but lack explanation. They do not address how that allocation interacts with the rest of the portfolio, how long it should be held, or what trade-offs it creates. Most importantly, they do not address opportunity cost. Every dollar placed into a non-productive asset is a dollar not working elsewhere. Another overlooked factor is the changing environment. In 2026, the financial landscape favors assets that generate cash flow and can adjust to higher costs. Many companies can raise prices, improve efficiency, and return capital to shareholders. Gold cannot adapt. It has no internal mechanism to respond to inflation or economic growth. It simply reacts to market sentiment. The deeper issue then is not gold itself. It is the lack of a system. Gold is often used as a substitute for planning. Instead of defining objectives, time horizons, and roles for each asset, investors default to what feels safe. Over time, this behavior leads to portfolios that are stable on the surface but fragile underneath. Understanding this dynamic is critical. Gold underperforms expectations not because it fails randomly, but because it is frequently asked to do a job it is not designed for. Once that becomes clear, it becomes possible to evaluate alternatives that address the real problem, generating sustainable, long-term cash flow and purchasing power. When gold becomes a central part of an investment strategy, several recurring mistakes appear. These mistakes are not obvious in the short term, which is why they persist. Their consequences emerge slowly, over 5, 10, or 20 years, when correcting them becomes difficult. The first major mistake is treating gold as a growth asset. Many investors do not explicitly say this, but their expectations reveal it. They assume that holding gold over long periods will meaningfully increase their wealth. Historically, this assumption is weak. Gold may preserve value during certain periods, but it does not compound. Over 5 years, this may feel irrelevant. Over 20 years, it becomes decisive. The second mistake is ignoring opportunity cost. This is the most expensive error because it is invisible. Suppose an investor allocates $100,000 to gold instead of productive assets. If gold delivers a real return of 1% over 20 years, that capital grows to about $122,000. If the same amount is invested in assets generating a 5% real return, it grows to roughly $265,000. The $143,000 difference is not caused by higher income or better timing. It is caused by the decision to prioritize non-productive storage over cash flow. The third mistake is overweighting gold due to emotional comfort. Gold often occupies a larger share of portfolios than logic would justify. Allocations of 20 to 30% are not uncommon during periods of fear. Over 5 years, this may not cause visible harm. Over 10 years, it creates a noticeable drag. Over 20 years, it can cut final wealth outcomes by a third or more compared to balanced, cash flow oriented portfolios. Another common mistake is confusing price stability with financial safety. Gold appears stable because it does not generate earnings reports or sudden bankruptcies, but safety without income is fragile. Inflation does not need to spike dramatically to erode purchasing power. A steady 3% inflation rate halves real value in roughly 24 years. Gold must outperform inflation consistently just to stand still. History shows that it does not reliably do so over investor relevant timeframes. A fifth mistake is using gold as a substitute for decision making. Investors often choose gold because it removes the need to evaluate businesses, sectors, or economic trends. This avoidance feels conservative, but it shifts risk into the future. The longer capital remains idle, the harder it becomes to recover lost time. Compounding works both ways. Missed years cannot be replaced later without taking more risk. The long-term consequences follow a clear pattern. After 5 years, portfolios dominated by gold feel calm but underperform modestly. After 10 years, the gap between gold-heavy portfolios and cash flow-based portfolios becomes measurable. After 20 years, the difference is structural. One group has assets that generate income and flexibility. The other holds value that largely depends on market price alone. Crucially, this outcome has little to do with income level. High earners and average earners make the same mistakes. The difference is not how much money is earned, but how capital is deployed. A disciplined system with moderate returns often outperforms higher income paired with poor allocation decisions. The problem, therefore, is not gold as an object. The problem is using gold as a solution to a problem it cannot solve. Once that distinction is clear, it becomes easier to replace static thinking with a system designed for long-term cash flow and resilience. The practical solution to the gold problem is not replacing one static asset with another static asset. The solution is building a cash flow-based structure that does what most people expect gold to do: protect purchasing power and support long-term stability. At the core of this approach are productive assets. These are assets that generate money on their own. Businesses earn revenue, pay expenses, and produce surplus cash. That cash can be paid out, reinvested, or used to reduce debt. This internal activity is the key difference. Gold has value, but it does not work. Productive assets work continuously. The mechanics are straightforward. Instead of allocating a large share of capital to a non-productive store of value, capital is allocated to assets with three characteristics: recurring income, pricing power, and durability. Recurring income means the asset produces cash regularly, not only when sold. Pricing power means the business can raise prices when costs rise, which is essential in an inflationary environment. Durability means the business model can survive economic cycles. In practice, this often takes the form of diversified equity exposure to companies with stable cash flows. These may include businesses in essential services, infrastructure, healthcare, consumer staples, or broad market funds that aggregate many such companies. The exact vehicle is less important than the logic behind it. To illustrate the mechanics, consider a simple comparison. An investor allocates $100,000. Option A places it primarily in gold. Option B allocates it to productive assets, generating a 4 to 6% real return over time. In option B, cash flows are reinvested. Each year, the asset base grows slightly larger, which then generates more cash the following year. This is compounding in its simplest form. No forecasting is required. The system relies on repetition, not prediction. Why is this approach stable rather than risky? Because risk is not defined by short-term price movement, but by the ability of an asset to sustain itself. A business that continues to sell products and services, even in weaker economic conditions, maintains value through activity. Short-term volatility may increase, but the underlying engine remains intact. Gold has no such engine. Its entire value depends on market perception at any given time. Another stabilizing element is flexibility. Cash flow-based assets allow adjustment. Income can be redirected, rebalanced, or reinvested. If conditions change, the system adapts. Gold offers no internal adjustment mechanism. It can only be held or sold. Importantly, this solution does not require complex strategies, leverage, or constant trading. It requires clear rules. Focus on income generation, maintain diversification, reinvest excess cash, and evaluate assets based on economic reality rather than headlines. Decisions are made periodically, not emotionally. This does not mean gold must be eliminated entirely. Gold can still exist as a small optional component for diversification. The key change is that it no longer carries the burden of long-term growth or protection. That role is shifted to assets designed for it. The result is a system that replaces fear-based storage with logic-based productivity. It aligns capital with economic activity rather than sentiment. Over long periods, this structure has one decisive advantage. It allows money to grow by doing something, not by waiting. When all parts are put together, the conclusion is not complicated. The mistake most investors make with gold is not buying it, but asking it to do the wrong job. Gold is treated as a solution to long-term wealth protection, even though it lacks the mechanics required for that role. Replacing this assumption with a clear system changes the outcome. The system itself is simple and structured around function, not preference. First, define the role of each asset. Productive assets are responsible for long-term purchasing power and growth. They generate cash flow, adapt to inflation, and compound over time. Gold, if held at all, is limited to a minor supporting role and is not expected to grow wealth. This distinction removes unrealistic expectations. Second, prioritize cash flow over storage. Capital should be placed where it produces recurring income. That income can be reinvested or used strategically. This creates a self-reinforcing cycle. Gold does not participate in this cycle. It remains static unless sold. Third, apply simple, repeatable rules. Assets are evaluated based on economic performance, not headlines. Reviews happen periodically, not reactively. This reduces emotional decision-making and keeps the system consistent. What changes over time when this structure is applied? After 1 year, the primary change is clarity. The portfolio has defined roles. Short-term market movements lose importance because they do not trigger immediate decisions. Cash flow begins to accumulate, even if modestly. The investor understands why each part exists. After 5 years, the difference becomes measurable. Productive assets have generated income and reinvestment effects, while gold-heavy portfolios often show flat real performance. A cash flow-based structure typically shows steady growth. The portfolio becomes more flexible. Income can be redirected, rebalanced, or held as optional liquidity. After 10 years, the outcome is structural. Compounding has had time to work. The gap between productive and non-productive capital is no longer theoretical. One portfolio provides options: income, reinvestment, and resilience. The other still depends primarily on price appreciation. The difference is not volatility, it is functionality. The immediate action required is straightforward. Review current holdings and assign each a clear purpose. Identify assets that do not generate income and evaluate whether they justify their allocation. Reduce positions that serve no productive role. Increase exposure to assets that generate sustainable cash flow. Establish a simple review schedule and stick to it. This does not require prediction, leverage, or constant activity. It requires discipline and clarity. The system works because it aligns capital with economic output, not sentiment. The final takeaway is neutral and practical. Gold is not a mistake. Treating gold as a long-term wealth engine is. In 2026, the assets that matter most are those that produce, adjust, and compound. When capital is structured around these principles, long-term outcomes become more predictable and controllable. That is the difference between holding value and building wealth.